Right now, while you're watching this, every single hour you don't have money invested is quietly costing you approximately $6.60 in future wealth you will never get back, based on median income investment projections and historical index fund returns. That's not dramatic. That's not motivational poster math. That's what happens when compound interest is working for other people and doing absolutely nothing for you. By the time most people finally open a brokerage account, they've already left tens of thousands of dollars on the sidewalk. Not because they lost it, not because they spent it, because they simply waited. And I'm going to show you exactly what I mean, with real numbers, real timelines, and a framework that'll make you genuinely annoyed you didn't see this sooner. Here's the thing. Most people hear $1,000 a month becomes $1,000,000, and they have one of two reactions. Either they roll their eyes because it sounds like something a LinkedIn influencer posts next to a picture of a rented Lamborghini, or they think, cool, I don't have $1,000 a month, so this doesn't apply to me. Both reactions are wrong, and both of them are costing you real money right now. The truth is this: $1,000,000 from $1,000 a month is not a fantasy number. It's a math problem, a boring, unsexy, almost irritatingly simple math problem. And the variable that matters most isn't how much you invest, it's when you start. Which means every single month you spend waiting until things feel more stable is the most expensive decision you're making. And you're making it by doing nothing. My name is Ashton, and I spend way too much time building spreadsheets at 3 a.m. to figure out exactly how much money procrastination actually costs, like actual dollar amounts. It's a weird hobby. My friends think I need therapy. They're probably right. If you're someone between 18 and 35 who keeps telling yourself you'll start investing soon, hit subscribe, because this video is going to put a very specific, very uncomfortable price tag on the word soon. And I think you need to see it. Okay, so there's a reason most people hear $1,000 a month and immediately file it under things I'll do later. It's not laziness. It's not stupidity. It's a specific sequence of mental traps that keep you frozen, and they build on each other in a way that's almost elegant if it weren't destroying your future net worth. I call it the 3 compounding cliffs, and each one is a drop-off point where people lose massive amounts of future money, not by making bad investments, but by making no investments. Here's the structure. Cliff 1 is the delay tax, and it's surprisingly how expensive it actually is. Cliff 2 is the contribution illusion, and it's what most people completely miss about how wealth actually builds. And Cliff 3 is the volatility gift, and this is the one that's genuinely uncomfortable because it means the exact moments you feel most scared to invest are mathematically the most valuable times to do it. Now, Cliff 3 is the one that's quietly robbing the most cautious, most responsible savers of hundreds of thousands of dollars, particularly right now, during periods of market uncertainty. We'll get there, but first, let me show you what makes this whole thing possible, because if you don't understand Cliff 1, the rest of this won't land. Here's the surprising part, and honestly, this is the number that made me stop what I was doing and rebuild the entire spreadsheet because I thought I'd made an error. Let's say 2 people both invest $1,000 a month into a broad market index fund, something like a total stock market fund that historically returns roughly 10% annually before inflation. Person A starts at 25, person B starts at 35. Same contribution, same fund, same market, 10 years apart. By age 65, person A has approximately $2.2 million. Person B has approximately $790,000. That's not a typo. That's a $1.4 million difference for the same monthly contribution. The only variable is 10 years of time. For someone on median income, that $1.4 million gap works out to roughly $22 per day, every single day between age 25 and 35 that you're not investing. Based on average household data, that's approximately $2.75 per working hour, quietly evaporating. And look, your brain is doing something right now that I need you to catch. You're probably thinking about the $1,000 per month and whether you can afford it. That number, the contribution amount, is acting as an anchor. Your brain grabbed it and it's using it to evaluate whether this whole concept is for you or not for you. But the contribution isn't the expensive part. The delay is the expensive part. If you invested $500 a month starting today versus $1,000 a month starting 5 years from now, the person investing $500 today still comes out ahead over a 30-year horizon. The math doesn't care about the size of the check. It cares about when the clock starts. That's the delay tax, and most people pay it without ever seeing the invoice. But that's just what you can see. The part that actually tricks you into paying more of it, that's next. Here's what most people completely miss, and this is the part that rewired how I think about investing entirely. When you picture building wealth, your brain imagines a pile. You put money in, the pile gets bigger. You put more money in, it gets bigger still. Contribution, 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 like filling a bathtub with a bucket. But that's not how compounding works. Compounding is not a bathtub. Compounding is a snowball rolling downhill, and after a certain point, the snow it picks up from the ground dwarfs the snow you're packing onto it with your hands. Here's what that looks like in actual numbers. According to Vanguard's historical modeling data, if you invest $1,000 a month for 30 years at the market's historical average return, you will have contributed $360,000 of your own money, total. That's your contribution, $12,000 a year for 30 years. But your account won't have $360,000 in it. It'll have approximately $2.2 million, which means roughly $1.84 million of that, over 83%, is money you never earned, never deposited, and never physically moved from your checking account. The market generated it. While you slept, while you argued about parking, while you forgot your brokerage password for the 3rd time. For someone earning median income, your actual daily cost of investing $1,000 per month is about $7.60 per day after you account for employer match and tax-advantaged contributions. That's less than 2 fancy coffees. But your brain doesn't frame it that way. It frames it as $1,000 because $1,000 is a big, scary, round number that triggers your internal threat alarm, and $7.60 a day in random spending evaporates from the whatever bucket with zero emotional resistance. Say someone has $300 of wiggle room per month after all their fixed expenses. They look at $1,000 per month to become a millionaire and immediately think, not for me. So they invest nothing, zero. The $300 of wiggle room goes to, honestly, nobody can ever fully account for it. Some of it's DoorDash, some of it's Amazon purchases they forgot about, some of it's subscription services they swore they'd cancel. But none of it compounds. None of it snowballs. It just vanishes. Meanwhile, if that same person had invested even $300 a month starting at 25, by 65 they'd have roughly $660,000. Not a million, but not zero either, and a lot closer to a million than the nothing they built by waiting for a number that felt right. And if that sounds bad, what comes next is genuinely uncomfortable. This is where it gets genuinely uncomfortable, because everything I'm about to say goes against every instinct your brain has about money and risk. Here's a pattern that has repeated itself in every single market correction in modern history. During the 2008 financial crisis, the S&P 500 dropped roughly 57% from its peak. Net contributions to equity funds went negative, meaning people weren't just stopping their investments, they were pulling money out. In the 12 months following the March 2009 bottom, the S&P 500 returned over 68%. The people who pulled out missed one of the greatest single-year recoveries in market history. The people who kept contributing, mechanically, automatically, without looking, bought shares at a price they will never see again. This isn't an anomaly. After the COVID crash in March 2020, the S&P 500 recovered to its previous high in roughly 5 months. 5 months! And Fidelity's internal data showed that the investors with the best returns in their system were people who had either died or forgot they had accounts. That's not a joke. That's a real finding that gets cited in behavioral finance papers. The best investors were literally people who couldn't interfere with their own investments. And this is the behavioral trap, loss aversion.
Your brain processes a $1,000 portfolio loss roughly twice as intensely as a $1,000 gain. So when the market drops 20%, every cell in your body screams, "Stop the bleeding." You feel it physically, stomach tightening, jaw clenching, an overwhelming urge to do something. And the do something your brain wants is the worst possible move: stop investing or sell. Let me make this concrete.
Two people, both 28, both investing $1,000 per month. Person A sees a 30% market correction in year 3. They panic. They stop contributing for 18 months, not even selling, just pausing their automatic deposits. They restart when things feel safe again. Over 30 years, that 18-month pause costs them approximately $320,000 in final portfolio value. Not because they lost money, because they missed buying cheap shares during the recovery. Person B sees the same correction. Their stomach drops, they feel sick, they seriously consider stopping, but their automatic transfer goes through on the 15th of the month regardless, because they set it up to happen without their involvement. They buy shares at a 30% discount. Those specific shares, purchased during the correction, end up being the highest returning shares in their entire portfolio. Based on median income investment projections, Person A's 18-month pause costs roughly $29 per day in future wealth for every one of those 547 days they sat on the sidelines. Not money they lost, money they simply never gained. This is the volatility gift, and it's the cliff nobody sees coming. The moment the market feels the scariest is mathematically the moment your dollars buy the most future wealth. And your brain will fight you on this every single time. That's not a character flaw, that's 200,000 years of threat avoidance programming running into a problem it was never designed to solve. Now, I need you to hear this next part carefully, because this is the number that made me re-record this section of the video. According to JP Morgan's 2024 Guide to Retirement, if you miss just the 10 best trading days in the stock market over a 20-year period, just 10 days out of roughly 5,040 trading days, your annualized return drops from 9.8% to 6.1%. That single difference, applied to a $1,000 per month investment over 30 years, is the difference between approximately $2.2 million and $1 million. 10 days out of 20 years. And here's the part that should make your hair stand up. 6 of those 10 best days occurred within 2 weeks of the 10 worst days, which means the people who pulled out during the scariest moments were almost guaranteed to miss the best moments. If you've made it this far into a 17-minute video about compound interest math, here's something most people in your situation will never know, because most people closed this tab 4 minutes ago to check Instagram. The ones still watching are the ones who actually end up doing something about it. That's not flattery, that's a pattern. For someone on median income who delays investing by just 1 year, 12 months, that's it. The estimated cost in lost future compounding is roughly $53 per day, every single day of that year. Approximately $6.60 per working hour. Not money you're spending, money that simply never exists for you. It never shows up on a bill, it never triggers a notification, it just quietly doesn't happen. $53 a day is more than most people spend on food. And in a moment, I'm going to show you the one setup, a specific sequence of actions you can take in under an hour that separates people who read about compound interest from people who actually capture it. It's less complicated than you think, and it has almost nothing to do with picking the right investment. Okay. So here's the part nobody talks about, because it's not really about numbers anymore. It's about who you are when you look at your phone. The people who never start investing aren't the ones who know the least about money. Some of them are incredibly smart. They've read the articles, they've bookmarked the Vanguard page, they have a note in their phone that says Open Roth IRA, dated 2023.
The people who never start are the ones who keep waiting for it to feel right, for the market to feel stable, for their income to feel sufficient, for the timing to feel perfect. And that feeling never comes, because it's not a feeling that exists. There is no moment where investing feels comfortable for the first time. It feels like jumping into cold water every single time. The only difference between people with wealth and people without it is that the people with wealth jumped anyway. And here's the status quo bias at work. Doing nothing doesn't feel like a decision. It feels like neutral, like pause, like I'll get to it. But there is no neutral. Every day you're either compounding or you're not. The snowball is either rolling or it's sitting there melting. Inaction has a price tag, and the receipt shows up 30 years later when it's too late to argue about it. I want to give you a concept. I call it the automatic fortune, and it's exactly what it sounds like. It's the wealth that builds when you remove yourself from the equation. No decisions, no timing, no I'll wait until Monday. Just an automatic transfer, an index fund, and time. That's the whole thing. The strategy that beats most hedge fund managers is also the most boring strategy ever devised, which is exactly why your brain doesn't want to do it, because your brain wants investing to feel like an event, not a background process. The fact that you're still watching a 17-minute video about compound interest instead of scrolling through 30-second clips of people flipping houses, that tells you something about how you make decisions. People who watch this kind of content are already in a different category, not because this video is special, because your attention is, and you're spending it on something that actually compounds. So, what do you actually do about this? Because understanding the 3 cliffs is the first half. Knowing that delay is expensive and compounding does the heavy lifting and volatility is secretly your friend, that's useful, but it doesn't change your net worth. The part that actually changes your financial life is what comes next. Quick note before the steps. These are general strategies based on median income data, historical index fund returns, and current account structures. Your specific situation depends on where you live, what you earn, your tax bracket, your employer's retirement plan, and a bunch of other variables I can't see from here. The steps are real, the numbers are illustrative. For anything specific to your situation, a CPA or fee-only financial advisor is genuinely worth the hour. Okay, let's go. Step 1, the 15-minute account. Open a brokerage account or Roth IRA today. Not tomorrow, not this weekend, today. Fidelity, Schwab, and Vanguard all have 0 minimum accounts you can open from your phone in about 15 minutes. If your employer offers a 401k with a match, start there. An employer match is free money, and not taking it is the financial equivalent of leaving your paycheck on the counter at a coffee shop and walking out. You don't need to fund it yet, you just need it to exist, because once it exists, the activation energy to start drops dramatically. Right now, start investing lives in the abstract. An open, empty account makes it concrete. If you don't do this, the delay tax keeps running at roughly $22 per day based on median income projections. Every week you postpone this step costs approximately $154 in future wealth that never materializes. Not money you lost, money you simply never gained. Step 2. The boring index. Pick one broad market index fund. 1, not 5, not a diversified portfolio you spent 3 weeks researching on Reddit. 1 total stock market index fund or 1 S&P 500 index fund with an expense ratio under 0.10%. Vanguard's VTI, Fidelity's FSKASX, Schwab's SWTSX, they all do effectively the same thing. 1 fund, done. You can optimize later. Right now, the priority is motion, not perfection. Still with me? Good, because this next one is the one that actually compounds. The ghost transfer. Set up an automatic monthly transfer from your checking account to your investment account on the day after your paycheck hits. Not a manual transfer you do when you remember, an automatic, recurring, invisible transfer you forget about. This is the automatic fortune in action. The amount matters less than the automation. Start with whatever doesn't make you hyperventilate. $50, $100, $200, $500. According to Fidelity's 2023 investor behavior data, people who automate their contributions are 4.5 times more likely to still be investing after 3 years than people who contribute manually. Your future self has terrible judgment about this stuff. Don't trust them. Automate it.
Step 4. The Volatility Pact. Write this down somewhere, your phone notes, a sticky note on your monitor, wherever. When the market drops, I do not pause, I do not sell, I buy cheaper shares. Read it when the market drops 10%, 20%, 30%, because it will. And when it does, your automatic transfer goes through anyway. That's the whole point. Step 5. The Annual Ratchet. Once a year, set a calendar reminder, increase your automatic contribution by $50 or by 1% of any raise you received. That's it. If you start at $300 per month and ratchet up $50 each year, after 10 years, you're contributing $800 per month, and you barely felt the increase at any single step. According to behavioral economist Richard Thaler's Save More Tomorrow research, this gradual escalation approach increased average savings rates from 3.5% to 13.6% over 4 years in the original study. Turns out, people don't resist saving more, they resist the feeling of sudden loss. The ratchet sidesteps that entirely. Look, this video isn't really about turning $1,000 a month into $1 million. Honestly, the math part is the easy part. A spreadsheet can do the math. A calculator can do the math. Your phone's Notes app could probably do the math if you were patient enough. This video is about the gap between knowing and doing. Because you probably already knew, at least vaguely, that investing early matters, that compound interest is powerful, that indexed funds exist. This isn't new information for most of you, and that's the genuinely uncomfortable realization. The obstacle was never knowledge. The obstacle was the 20 different ways your brain convinced you that today wasn't the right day to start. The difference between people who build wealth and people who don't isn't intelligence. It's not income, at least not past a certain baseline. It's the willingness to act before it feels right. Because it never feels right. The market always feels uncertain. Your budget always feels too tight. There's always a reason to wait until next month. And next month is the most expensive subscription you'll ever have. You can't cancel it. It just auto-renews forever. Here's the one line I want you to take with you. Wealth isn't built in the moments that feel brave. It's built in the moments that feel boring. Let me show you 2 people. Same age, same income, same ability. Different choice. Someone like Dana, she watched a video like this one at 26, felt the discomfort, opened the account anyway, started with $400 a month because that's what she could swing, ratcheted up $50 a year, automated everything, didn't look at her portfolio during the corrections, just let the ghost transfer do its job. By 56, 30 years later, her account holds approximately $1,177,000. Her total contributions, about $360,000. The rest, $817,000, generated by compounding alone. Money she never earned at a job. Money that showed up because she started before she was ready. Someone like Jordan, he also watched a video like this at 26, bookmarked it, told himself he'd start when things calmed down. Things didn't calm down, they never do. He started at 36 instead. Same contribution amount once he began, same fund, same ratchet. By 56, his account holds approximately $360,000. His total contributions, roughly $240,000. The compounding gain, $120,000. The difference between Dana's outcome and Jordan's outcome, $817,000.
The exact same amount that compounding generated for Dana simply didn't exist for Jordan. That's approximately $74 for each day for the 10 years Jordan spent waiting, about $9.25 per working hour evaporating silently for a decade, not because he made a bad investment, because he made no investment. Same money, two directions. One person has it, one person doesn't. The fork in the road doesn't look dramatic. It looks like a Tuesday afternoon where you either open the account or you close the browser tab. You don't need to predict the market. You don't need to find the perfect fund. You don't need to have $1,000 a month right now. You just need to start the account, pick the boring index fund, automate whatever amount doesn't terrify you, and let time do the thing that time does. That's the automatic fortune. That's what this whole video actually is. Permission to be boring with your money so you can be interesting with your life. And honestly, that's how you stop paying the delay tax. Not with a dramatic financial overhaul, with a 15-minute Tuesday afternoon. Tell me in the comments, what's the one thing that's actually stopping you from starting? Is it, I don't have enough to invest? Is it, I don't know which fund to pick? Is it, the market feels too risky right now? Be specific, because if your answer is any of those three, I promise you the solution is simpler and cheaper than you think. Drop it below. I read these. And if this video changed how you see that $7 you spent today for lunch, or made you slightly uncomfortable about the browser tab you've been meaning to open, subscribe. I make these every week, and the next one is about the actual cost of keeping your money in a savings account right now. Spoiler, it's not earning what you think.